I'm obsessed with the experience. When I see someone having a poor experience, I want to fix it. I want to find out why. Even I don't care if the person messed up the application or messed up the upload or had the wrong documents or picked the wrong program. It doesn't matter. It's about that end user. That customer themselves was trying to get a loan through a broker, and we want to make sure that's right for them.
Welcome to Powerhouse, where we interview the biggest names in housing and ask them about their strategy for growth. I'm Diego Sanchez, president of HousingWire, and my guest today is Robert Pieklo, CEO of American Financial Resources. Rob, it's so great to have you on the show.
Diego, thank you so much for having me. Excited to finally make it to the Powerhouse one. You know, we've worked our way up slowly to get to this one, so I'm excited to be here. Thank you so much.
You've done the 10-minute talks. You were just on stage last week at the Mortgage Banking Summit, and here we go with Powerhouse.
Exactly. Ready to rock.
Good stuff. So I did just interview you on stage at HousingWire's Mortgage Banking Summit, and absolutely love your enthusiasm for the broker channel. Why are you all in on wholesale?
Boy, it's a great question, and I love answering it because I'm passionate about it. You saw that on stage, and it's really truly deep down. I believe it's the best place for a consumer to get a loan because I lived it. I kind of went through the iterations of my career and had a small, tiny broker shop for a couple of years just recently, and got to kind of live that experience. And when you have a channel that is competitive in nature, not only do you have the loan originators competing for the loans, but then have a bunch of crazy people like me, battling, 200 other lenders to win that loan. It creates an environment of competition where the brokers have a really good opportunity to win. And when they win, their consumers win. So
for a long time, there was a brokers are better motto, in terms of the battle between wholesale and retail. It sounds like you actually have some reasons for why brokers are better.
Boy, it's you're going to catch me on this one. We'll have some clips about this, but no, I do. I believe the channel itself, it just creates competition, and whenever there's any type of opportunity to create competition, it drives down prices. It creates innovation. I think some of the biggest issues that we've seen in the mortgage industry as a whole is a lack of competition. If you look at how our technology plays out, if you look at kind of the LOS game and kind of how we're living in a 2010 technology for most of us, and seeing that it's the lack of competition that has caused the lack of innovation. And here, as you compete, like I know that I have to invest in technology, I have to invest in my pricing, my capital markets, my service levels. I have to do it all to win the loan. So when there's competition, the brokers just have a better opportunity to deliver something to their customer versus someone who's just stagnant and content in how they're delivering their loans.
Yeah, I love that perspective. So how do you and your COO, Michael Brenning, split up the executive responsibilities at American Financial Resources?
He is... he's more of the execution guy. I'm the idea guy. We'll call it that. We're so aligned, and that's really important when you have an executive team. Our entire executive team is incredibly aligned of where we're going, how we're trying to do it, and we'll have our battles obviously here and there on how to do certain things, which is it's really healthy. And for me, it's more about driving revenue growth and making sure our capital markets execution is the best on the planet. And then his primary job function is make sure that the loans go through the manufacturing process as smoothly and as quickly as possible. And he's also overseeing our technology group, which is amazing. And then he also does our ancillary services programs as well. So we kind of split it up that way. I get to do a little bit more of the lead singer part, the front man of the band. I get to do some of these things and get out there and speak on behalf of the company and what we're trying to accomplish. But you're going to see a lot more of Michael Brenning coming soon.
Amazing. Do you enjoy that work, sort of the lead singer role, being out front and having the ideas and being the visionary?
Yeah, I do. Sometimes I love it and sometimes I hate it. You can't hide. Right. So when you're out front and you're out there speaking about the company, and when you're passionate about a channel or just the business, the industry in general, it comes with the good, and with it comes some bad as well. So being at events, speaking at events, going to different company events that are out there, or going to different trade shows, being on podcasts, being online, being heavily on social media. I don't shy away from social. I'm envious of some of those that are not on at all, but I'm in there. When you're in the weeds doing that, it's you're going to get all of it. You're going to get the good and the bad. And I truly, at this growth stage, it's nice. But as we kind of go through the maturation process of a mortgage company, we know that that's going to get a little bit old being out there and getting the bad, because we're fixing. You can only fix so much. You have to make sure you start delivering for your customers.
Yeah, that makes sense. So you're almost 2 years into this new iteration of AFR. What kind of culture are you and Michael trying to build at the company?
Yeah, I mean, I think it's just 20 months now. We have 4, I think February will be 2 years. And it's been a seismic shift. The culture is kind of, I just want to create an environment where people want to come to work, right? They want to enjoy what they do. They want to try and help as many people as possible. They want to be innovative. They want to be on the forefront of where we're going and what we're building. So we want to bring people in like that and create a culture that is incredibly grateful for the opportunity that we have when we get a loan. And we talked about it before. I think what was inherited when we purchased the company was a bunch of really good, experienced people, but the mindset was that you're lucky that we're doing this type of loan. We were more of a niche lender, so you're lucky we're doing this loan, and you'll deal with our timelines. So we had to kind of flip the script and understand how hard it is. And there's originators, when you're out in the front lines of origination, a referral partner sending you a loan or a lead coming in, that might be 6, 9, 12 months of a cycle to get someone to get a loan and get an opportunity for even a pre-approval, let alone get a contract in. Then you get a contract and the person's ready to rock and roll, and they have 200 lenders to choose from, and they chose us. Like, that's the mentality I want our team members to have. Not like, oh, you're lucky I do this renovation loan or this kind of one-time closed construction. We'll deal with it when we get it. It's holy cow, let's drop everything, make sure this experience is incredible, because we're very lucky and grateful that after all of that work the originator put in, they chose us to fulfill. Their whole relationship's on the line. If we fail, they may never get another loan from that referral source that might have taken them years to culminate. So here, to cultivate, I should say. So with that kind of mindset, we created core values. We've enhanced the team member experience so they know that we care about them. PTO, pay, benefits, the whole thing. We've changed what we do here at AFR and made it a desirable place to work.
Yeah, it sounds like you're just trying to build a customer obsessed culture, and the customer is the mortgage broker. You got to be obsessed about them.
That is, obsessed is a word I use a lot because I'm obsessed with it. I'm obsessed with the experience. When I see someone having a poor experience, I want to fix it. I want to find out why. Even I don't care if the person messed up the application or messed up the upload or had the wrong documents or picked the wrong program. It doesn't matter. It's about that end user. That customer themselves was trying to get a loan through a broker, and we want to make sure that's right for them. So we want to have, when you're jumping on board here and how we're hiring now, you kind of have to be a maniac about it. You have to really care and be obsessed with what that experience is like. That's how we've been able to grow with such a little increase in headcount. There's people out there hiring thousands of people. And that's like, we're doing what we're doing, closing thousands of loans a month, or 1,500 loans a month. Right now we have like 270 people, and most of our hires are around tech. So, that part of it, I kind of put us up against anybody when it comes to a unit per team member headcount number. So we've been delivering on that side of it, and it really just goes to show of who we're trying to bring in and the type of person we're hiring.
Is that ability to grow volume without really growing headcount, is that the quality of the people that you're hiring? Is that technology? Is that innovation? Is that AI? Like, what are all the things that are leading to that ability to grow your top line without growing the team?
Yes, it's all of it. So you can't just do just one. But the first thing had to be a shift in what the expectations are. What we did internally, and I said it to everybody, they may take it negatively to start, but they start to understand, like, having incredibly high expectations of your team members is a compliment. Like, everyone walks into the mortgage industry, it's like, oh, underwriters do 1.5 loans per day or 2 loans per day, or the system is old and clunky and doesn't work. Like, that's the immediate mindset and thought process of most of the people in our industry. And you just have to kind of like flip that around and say, no, like, we have the expectation. You're incredibly experienced. You know how things work. Let's find a way. How do we get our numbers to 8, 9, 10 per underwrite, per underwriter per day? How do we get our speed in closing and get the documents out quickly and correctly? And then separately, how do we get our QC processes in line? Make sure we're doing high quality loans, which we are. We've shifted the type of loans that we've done here from niche to mainstream loans. How do we do that and do it with high quality and have lower defect rates than we had before? So it's a combination of it all. But the first thing was that shift in mindset of expectations. You can't walk in with this predetermined, like, oh, this is what mortgage companies do in this type of system. We've kind of thrown that out the window. Now, we do own a lot of our proprietary technology and our customer experience. So that helps us, especially over the next 30, 60, 90 days. You're going to see a lot of things that are being released by AFR that are very exciting. So as we do that, but the whole idea is get the right people in. When we're bringing folks in, they have to be tech savvy. They have to be tech oriented. They have to have a relationship with AI. I call it a relationship because it's ever evolving. They have to have a relationship with AI and understand how to use it to be somebody that's going to work here.
So how are you thinking about growth in 2026? Are you going to focus more on going deeper with your existing broker partners, or are you still in that phase where you just got to keep adding a lot of new broker partners?
So being a niche lender to start, right? That's what we acquired a company that was heavy in one-time close construction and renovation. That was like 70% of their business that they were doing. So we had a wide array of people who signed up with the company already. We had 3,000 brokers that were signed up. So like the initial part of this was like, we didn't really need new acquisition from a broker perspective because we had so many people already approved. We just needed them to send us a loan. And some of those folks maybe didn't have a great experience when they sent the normal loan, or they would never even think to send you a normal loan. And I say normal, but like a regular conventional loan or regular FHA loan versus these niche products. So we had that base already. But what we found is we've kind of deepened the relationships with a segment of our approved customers that loan originators leave. They'll go to another company and they want to sign up with you because they used us at the first company, or originators starting their own broker shop and they would like to have us on the slate as a lender at that new broker shop. So we're expanding that way. It's kind of it's both. So because we've deepened the relationship with our current approved brokers, just like it's natural tendency was people leave or start their own companies and grow. They want to sign up with us, and we've been bringing those folks on as well.
It sounds like it's also moving beyond the kind of specialty product provider to also being a good source of what's conventional.
It is. And it's funny because, the experience is getting better with the say less, I don't know what the term would be, but tough, like just tougher loans, right? It's hard to have a manufacturing process that's scalable when you have tough loans. There's plenty of companies that take in some of the lower FICO stuff or stuff with more hair on it, a lot of manual underwrites. Like we do those as well. But it's just difficult to have a scalable process where people are going to have expectations met. So by bringing in these loans, our specialty products have actually declined slightly since we took over. And the big percentage growth, especially in wholesale, that I throw out around the 900% growth number a lot. But of that 900%, majority of it is just standard conventional loans and government loans, because our capital markets team has done an incredible job of being really, really competitive out in the market, and people want to use us for it. And it's been a lot easier to help, build and grow the operations part of this with cleaner loans that just move through the process more quickly. So it's a little bit more of a scalable opportunity out there. It's difficult. You see some of the big lenders out there tout like how fast they can get a clear to close. And when you're trying to break into certain broker shops, like the first loan, I promise, isn't the one they were going to send there. That first loan you get, it's still that, tough loan, tough deal that maybe someone else couldn't do. And you have to try and win over somebody with that. But once you do that, you then tend to get some of the higher quality stuff that can move through the process faster.
So again, I really love your enthusiasm for the channel, but 20 months ago, when you were thinking about this opportunity and moving into the early stages of this opportunity, AFR, how did you think about your ability to compete with these behemoths in wholesale who have almost unlimited tech and client service budgets? How do you differentiate from them?
Experience and from. I say it all the time on stage, and I don't discount it. I think there's a huge disconnect with some of the larger companies of what it's like to be on the front lines anymore. It's that they're just simply not that company anymore. They have levels and levels and levels and hierarchy, a significant amount of people that are in between who makes a decision or not, and what we're going to build for who. A lot of people, especially the larger entities, feel like they know what's best for the brokers. And we don't feel that way. We feel like we're in the trenches right now, building some stuff that nobody else is building. We are taking a pathway that others are not, in how we build our portal, how we build the experience, how we're building our use of, AI in terms of how it's going to be in the system. These things that we're doing are because we're in the trenches with the brokers. We're getting feedback real time, and we're not this huge company that when I make a change, I'm affecting, 3,000 loans in the pipeline, not, 40,000. So it's a big difference when we make these changes and implement technology that for us, we're a little bit more nimble. We definitely punch well above our weight class when it comes to battling these guys out there. And we do think we have a better approach when it comes to the relationship side. And then also on the capital market side, we feel we have the best capital markets team on the planet. We think that we're going to continue to have the best capital markets team on the planet, creating different markets and creating different ways to execute, then pass that through to the broker channel and the originators that use our services. So we feel like we do have ample opportunity. And to be honest, the broker channel is tired of hearing that there's just two lenders. The channel was built on choice. It was built on opportunity and competition. It isn't a 2-horse race. And one, you can't use the other. That's not how the channel was created, and it's not what made the channel so competitive in the heyday. It's right now there are hundreds of lenders. We were on stage with a great lender in PennyMac that's devoting a ton of resources to the channel as well. And there's other people that are vying for these loans. So we think it's a great time to be in it, and we think we can, with our approach, we think we have a significant advantage. Because we know the broker channels, a lot of the brokers are tired of hearing that there's only one or two people they can work with.
Great answer. I appreciate that very much. So let's dig in on capital markets a little bit. We've seen UWM, one of the behemoths, offer significant rate incentives as they try to stay number one in wholesale. How do those rate incentives impact your business at AFR?
It's you could feel it right away. Like when you do a refi incentive and allow for people to change comp plans and make it much less on refinances and bring stuff in, we don't allow for that. You feel it. Like we wore it when they got aggressive on their refi incentive that just rolled out and rates did move down a little bit. Like we certainly saw refinances, not that it was a big piece of our business, but go from like 18% to 14%. They do have an effect. But listen, we know that there's short-term things that these guys are going to try and do and win business over. Longer term, they're going to widen. They have incredible amounts of expenses. They have shareholders to report to. We understand how margins work. We stare at it every single day. I could have told you where their margins were going to be at the last quarter. Like we knew exactly where they were going to be. We knew they're going to have to widen at a certain point. So like when you look at these larger companies and doing gimmicks and make you do this or do that, we think there's an opportunity simply to offer really, really good pricing. That's it. Don't have to do these certain things or accomplish certain levels. We're just going to offer this pricing out. Yeah, we have certain tiers for people that send us a certain amount of loans or have a higher quality of loan. Sure. There's math behind that, behind pull through and some other things, but we're not going to make brokers go through a lot to get the best pricing. Like we want to provide that out there because we know that if we provide really good pricing, we're going to get the best loans and it's going to be more scalable for our business. So we think that, as they continue to run different things and incentives, and this is a bunch of companies, not just the one, but as they do that, we think we still can compete. We know where margins are. We know our execution, which is, again, our execution is incredible right now of what we're getting out in the market. So we think we can compete with the big guys at all times, even if they go super low on margins. We do know they have earnings calls. They have to meet certain things. So we're out there and we're monitoring that and making sure that we're in a place that we can be incredibly competitive. But when they do these drops, we have to wear it and just live through it over the week or two as these things are super low in margin, and battle to win our share and then expand when we can expand.
All right. Flipping to the other behemoth, you had a fairly provocative comment when I posted recently about Rocket Pro's new broker manifesto. What do you think about what Rocket is building at Rocket Pro?
I've been vocal. on Rocket itself. And I don't think I'm wrong. Like, please, if anybody thinks I'm way off base on this, message me and give me the reasoning behind it. But Rocket, got into the channel or started pushing the channel a ton, holding their nose. And that's the way it was. They tried every which way to get business outside of the broker channel. They couldn't break purchase share. They tried to do it through call centers. They tried to pay State Farm agents. They tried to pay realtors. They tried distributive retail. They tried anything that they possibly could to get purchase market. When rates went up, they didn't get the purchase market, right? UWM stormed. That's how United Wholesale Mortgage became the number one lender in America, was because purchase, and there wasn't a lot of refi, right? That's fact. So they've tried every which way, and then they came to the realization that the last mile of origination is very hard. I came to that same realization. I'm not saying people can't change. I changed. I wrote a whole piece about distributed retail dying, and I discounted the last mile of origination. It's so important. Early in my career and later in my career, I found that out. I think they're doing the same thing. They've brought in some people, different people that have different mindset, different thought process. There's still some folks that are running the show behind the scenes that have the same, mentality, but I think this time around, they finally said the only way they can break into the purchase market without distributive retail is to go through the wholesale channel, and they're investing in that. Now, Dan and team, like I said, they've built a great team around it. I think we can compete. I know they're huge, and people will laugh at me. They think I'm nuts when I say I can compete with UWM and Rocket. I think the more and more these companies bring in folks that have never originated alone and never been on the front lines, the better opportunity we're going to have to build something that differentiates ourselves from them. And that's something that we're seeing. And I think that's resonating with the broker community for us.
Well, I've seen it at HousingWire. Obviously, we're in a different space, but there's real power in sticking to your knitting and staying nimble. So I wouldn't bet against you for sure. And again, I love the enthusiasm. So and you're showing results, right? You're scaling quickly at AFR, and I know you have plans to scale even more. Is M&A, again, because there's like you said, there's a lot of other wholesale lenders, some of which are going to be competitive, like you have been able to be competitive, and some of which are not. It could M&A be part of your strategy in order to scale up more quickly at AFR?
I'll never say no, but it's not part of our plan, right? We're not looking for anything like that right now. What we're looking for is capital, use of capital, how we, determine whether we're going to keep MSRs or not, and how we're going to play in the game. So like the growth cycle has been extraordinary. We're doing it. I said it on stage with Clayton and saying that we've done it profitably, which I'm incredibly proud of, because it's really hard to scale, grow volume, meet your covenants and all the fun stuff that you do, and make money. Right. That's something that is it's discounted. I feel like it's like cooler if I said we raised $30 million and I burnt it all, everyone would be like, oh, they're cheering you on. Here I'm like, we raised money just to buy the company, have kept all the money in the company, have grown the way we've grown, and have been profitable for a significant portion of that. We did catch a falling knife. I will be open to admit that, but we turned it around quickly and have excelled there. But for us right now, M&A isn't in the cards. What we are looking to do is just determine how we're going to use capital, potentially raise capital, and how do we deploy it to grow faster. Because right now we're bumping up against every leverage covenants and capital ratio covenant that we have, because we're growing so quickly. And that's something I know that we have to manage through. It's been a really good problem to have and manage through. Liquidity is not an issue. So like we're in a good place, but we are looking to grow even faster, and would look to take on potential capital partners if that helps us get to where we want to be faster.
You brought up PennyMac before. You shared the stage with Kim Nichols, who's their head of their wholesale efforts. How do you think about servicing? Because you have a lot of mortgage companies like PennyMac, like Rocket. Rocket just bought Mr. Cooper and closed on that deal. Where the main strategy is they're going to build this massive book and they're going to originate from that book. So how do you think about servicing as somebody that wants to be really competitive in wholesale origination at AFR?
Yeah, I think this is going to be a bit controversial, I guess, but I think servicing value and the kind of lifelong customer that a lot of these companies are taking the approach of is incredibly overstated. I think a lot of the customers, a majority of the customers, are setting an ACH, and other communications are just annoying. They're setting this up. This isn't this life. A lot of the recapture numbers you're seeing now are deemed by practices that are waking the dead, meaning that somebody who really wouldn't have done anything anyway, but you've pummeled them with so much marketing and advertising that they make a decision to do something. And it's because of what you've advertised. You may have spent thousands to get that person to say, you know what, maybe I will take a cash out now. But in reality, when rates move down, we'll see the true indication on what's going to happen with the servicing portfolio, because we know that they've priced and valued a lot of opportunity in recapture and the revenue that comes from it. But from what we're seeing and how when they do try and battle and win alone, I guarantee you that the margins that they said that they were going to make in that recapture theory and analysis isn't what they're going to end up with. So it's an interesting take on it. Now for us, I think when MSR values come back to like a reasonable number, we do want to participate. We'd love to keep servicing. We'd love to have an opportunity to do what they're doing. Obviously, I'm not saying it's a horrible strategy. I'm just saying how it's currently priced and how they currently book it. There's a lot of value that is being taken into account. Whether if they're not booking it because of gap rules, but if they're pricing the opportunity for recapture, there's a lot of numbers that are being put in there and thrown out there that give these higher multiples that I can't compete with right now. Right? I don't have the liquidity to do it. I don't have the cash. It's incredibly cash intensive. If your margins are, 25 or 45 basis points of net margin, and the MSRs are worth 200 basis points, you can see you're underwater a significant amount in terms of liquidity and cash. So, but that part of it, we do think. Longer term, when things come back to reality and there's opportunity, we do want to keep them on the books. It's great for the broker channel. I don't like selling MSRs. I know everybody does it, but it's not the best when it comes to the kind of the sentiment from the broker channel and their customers going to someone that might refinance them. So that part of it is tough. So we'd love to be able to do that, but right now it doesn't make a lot of sense with the bids that are out there.
Yeah. So I mean, if I were to summarize that. The MSR values are so rich right now that it would almost be foolish to hang on to a lot of them because there's so many folks that are willing to pay up right now, and to the point where you think they may not earn that value back over time in terms of their ability to recapture.
Yeah, I would say that, and there's internal modeling. You can do internal modeling, not value it as much. And that's not overstating anything. I'm not saying there's any weird accounting practices happening. I'm simply saying that the way people are pricing is as if there's going to be 1, 2, 3 turns at a recapture. Yeah. And I just don't see that. I just don't believe deep down, especially when you're purchasing from another channel, that there's this incredible loyalty to who you set up your ACH for and with. I just don't see it. They're not in the portals. They're not in there all day long getting the marketing material. They're getting email going into spam. I just don't think there's that relationship. That relationship still resides with the originator. And I think that's going to come too without significant sales and outreach, meaning that, other people are going to be fighting for that customer as well and lowering the margin expectation. I just don't see it. I think the values right now and what people are putting into those values are a little high for us to be able to compete. And when things normalize and we see our first wave and see where prepayments are and what the MSR numbers come in at, then we'll probably be able to compete once that first cycle happens.
Rob, this has been a really interesting conversation. I love chatting with you about the wholesale channel and about mortgage origination and servicing in general. So appreciate you taking the time today to join me on Powerhouse.
Thank you so much. And listen, big shout out to HousingWire, to you, to Clayton, and including little guys like us. And I know we're growing, but without the stage, getting to meet the people we get to meet with, getting to go to some of these events, getting to speak and share our story, it is, I can't say, I couldn't be more grateful for the opportunity to have with you guys. You guys have been great to me, been great to AFR and our team. So I just want to say thank you. And we'll keep, I'm a paying subscriber. Just, I do full freight on my subscription, and that's where I go for all my news in real estate and mortgage. So thank you.
Well, we'll have to clip that line right there. Really amazing stuff, Rob. Thanks so much.
Awesome. Thank you, Diego.